Good morning, everybody. Welcome to the Flow Show. Here we go again. Nice sunny day here in the UK for once. Makes everything look a little bit brighter. Morning, Kate.
Good morning, Ryan. Good morning, everybody. Yep, ray of sunshine. It's always a positive, yeah?
Yep. Puts different shine on the day when you wake up in the morning. Right, let's get into it. Not an awful lot of headlines and stuff, obviously, with the US shut yesterday. Lots going on in Europe around what's happening in the Ukraine and whatnot. So we'll go through that. Obviously, we've got the RBA meeting as well. Right, let's start in Japan. Anyway, BOJ's Ueda was up before the beak, saying last summer's volatility was mainly caused by market concern over weak US jobs data and a US economic slowdown. Might have been the case, but that doesn't wholesalely explain the weakness in the end that they saw at points. But anyway, he says, we are aware of views that we have not been clear enough in our policy guidance, which might suggest they offer a bit more clarity at their next meeting. We'll have to wait and see for that. The RBA, they went and cut the 25, as was widely expected by the market, but it wasn't in any way, shape or form a dovish cut. In the statement, they said the board decided to lower the cash rate target by 25 pips, acknowledging the disinflation progress, but that the board is still cautious about the outlook. They said they trimmed mean inflation eased to 3.2% over 2024, and it is expected to reach the 2 to 3% target range early in 2025, which is sooner than expected at the time of the November statement. So that's probably the only dovish concession they've made there, that inflation might be coming down quicker than they expected. Governor Bullock said further cuts will be data dependent. We cannot declare victory on inflation yet. The strength of the jobs market has been surprising. And that further rate cuts that have been implied by markets are not guaranteed, and that we cannot get too ahead of ourselves on rates. She also said that the rate cut was a difficult decision. So that shows you how close to not cutting they might have been on that. She also said that the market path on rates is unrealistic if we want to hit our 2.5% target. So they're on their cut path, whatever it is. Doesn't look like, Kay, we're going to get a quick follow-up unless we see an outright collapse in the data.
Yeah, exactly. And Bullock, her own self, not wanting to give too much away, and for sure not going to start changing her stance to a more dovish one. So good, yes, warranted. Yeah, there were enough reasons as we discussed, and they did it. And now back to data watching, I'd say, with in mind that Bullock is not a dove.
Yeah, absolutely. She's not dovish in the slightest. Now, naturally, what we saw in the Aussie dollar was not a lot, really. After that, where's it gone? Up here. Aussie dollar itself not doing very much at all. We had a little dip back. It held that 63.30 break point that had been a bit of a sticky area in bounces above 63. So that's constructive for further upside, at least versus the dollar. We ran into this zone up here, 70s, 80s, just a small minor bit of traffic going back to these bottoms and resistance S&R area there, which we hit yesterday or yesterday evening. So yeah, technically it's doing okay. It's holding where it should. This hold here really can give it a bit of a base to then go and push maybe up towards the 64 level. But we'll have to see about that. We know the ballpark now. It's 63.80s, 70.80 and down to 63.30. If we're coming below here again, then we might be seeing a little bit of a washout. But as long as we're above 63, it should be looking a-okay to potentially keep going. Aussie Kiwi, though, that had more of a reaction, a complete turnaround from where we were yesterday evening, right back up testing these highs. Not unexpected, really. As we said, an undovish cut. And we've got the RBA coming up. Sorry, the RBNZ coming up next. So I would not be surprised to see us maybe having a move up towards this area, if not up towards the 112 in Aussie Kiwi. I have added a bit to my short position here at 11.40, and I'll add a bit more up here into this area there and see what happens if we're going above it. Right, moving on, UK and jobs data out for what it's worth, given they're still fucking around trying to count these numbers. Anyway, they are what they are. The unemployment rate came in unchanged at 4.4%, was expected to tick up a pip. Earnings fairly strong, as was expected. Probably some bonus, end of year bonuses potentially in the mix there. But the included bonus number rising to 6% from a revised down 5.5%. So was expected to rise anyway to 5.9, but it beat that. Take away bonuses, pay increase as expected to 5.9%. So still strong pay numbers coming in for the UK. No washout from that yet. The claimant count was up a touch, 22,000 from a better revised minus 15.1 previously. But the 3-month employment change looked a bit healthier at 107,000. That might have some holiday hiring in the mix as well, covering obviously the busy holiday sales periods as well. Overall, not much to take from this data. We'll see if those wage gains hold in the next numbers coming up. It wasn't the disaster it could have been. I think that's the main take from this one. Bailey was out not long after. He said, we are still in a period of high uncertainty. Disinflation is continuing. We are facing a weak growth environment in the UK. Talking about inflation, saying we are facing a short-run hump of inflation, but it doesn't expect that to filter through to second-round effects, although it may do. It says the labour market, and he was speaking on this data, is not out of line with their forecasts. Pay growth is up, but not as much as expected. It says we haven't seen anything in the latest labour market data that fundamentally changes our view on the outlook. So a bit neutral, still saying disinflation is evident. That can lead them to further cuts, but it's not happening any way fast. And the labour market isn't doing that badly anyway. Kate, anything to take from the data or Bailey?
No, not really. No, absolutely not. Yeah, as you say, not a disaster it could have been. Yeah, perhaps a bit of year-end stuff in there. We will have to see the New Year's numbers. As I've been saying many times, what happened in 2024 is, and even like to a certain extent in January this year is going to be very quickly in the rear view mirror. I'm actually less positive, although I'm a bit long sterling, but for various reasons. But I'm a bit less positive still towards the risks in sterling upcoming. I'm just a bit long sterling because of just the price action really, and but it's mainly euro sterling. The cable is really small. Yeah, I think there's potentially still more risks on the horizon than what we are seeing right here and now.
Yeah, absolutely. And there's certainly nothing that leads us to think they're going to be jumping on the cut wagon anytime soon. But who knows what data we get until then. Right, did I get a bit of final CPI data out of France? Nothing to write home about. The Eurozone HICP measure unchanged, 1.8%, although their own CPI measure had a jump to 1.7% above last month and expected. So a little bit of an inflationary hump for Europe as well. Over in Germany, we had the zoo data out, or the survey data out. Current conditions improved slightly to minus 88.5. Got to remember the minus in that. So slightly better improvement than expected. Expectations also ticking up to 26 from 19.9 or 20 expected, up from the previous 10.3. So a little bit of an improvement there. It's still, yeah, exactly, Brian, less crappy than it was last month. Certainly not good yet. Bundesbank's Nagel was saying that Germany would be particularly hard hit by US tariffs, but the blow to the US could also outweigh all benefits. Typical, it might be bad for us, but it'll also be bad for you line. He said 2027 GDP could be 1.5% lower than forecast on the US stuff, and inflation could rise if US policy changes drastically. So not looking forward to that. Hawke Holtzman, he's well and truly back on the hawkish bus. He says the danger of undershooting 2% inflation is not a reason to cut. He's been with cuts most recently, but it seems he's had enough of those. His last comments have been about not cutting further or cutting too far. So, to say, he's back on his hawkish bike for that. Fed's Harker says current economy argues for a steady rate policy for now. Fed's Bowman, we need greater confidence in falling inflation before cutting rates again. Fed's Waller, uncertainty over trade, other policies shouldn't paralyse rate moves, i.e. we should be able to keep going. Recent CPI data was disappointing, but could be the result of seasonal adjustment issues. Putting out all the excuses for that. This is not putting too much weight on January retail sales either, given the impact of the cold weather. Yesterday, we had the OPEC sources story saying that they are going to delay hiking their output in April. Russia's Novak says OPEC Plus is not considering delaying the April oil restart. So here we go again, playing the old ping pong, the OPEC ping pong. Ukraine President Zelensky is going to visit Saudi Arabia on Wednesday. We know that the US and Russia have been meeting out there, will be meeting out there. But he says Ukraine will not participate in US-Russia talks. France's Macron, always one to feel left out when there's big meetings going on. He's drummed up an emergency European summit on Ukraine. His nose has been put out of joint with all these US-Russia talks that they're not involved in, and he wants to be involved in it. EU Economic Commissioner Dombrovskis says we are looking at EU fiscal rules flexibility for defence spending. There was a summit, this summit in Europe, and everyone's pretty much agreed they need to up their game as far as defence spending is concerned. However, they don't want to fall foul of fiscal rules designed by the EU. So they want all those fiscal rules changed so they can borrow more money, spend more money, and it doesn't hit their accounts in the same way and follow the rules. The usual EU shenanigans. If you've got a goalpost in the way, you move it. He also said that EU's economic growth is expected to be slightly lower than was forecast in the autumn. Kay, all this Ukraine stuff, it's all mooching around. We even had comments from Russia saying that Trump is a problem solver. That seemed like a very fairly bullish and complimentary comment. Is he going to get something done?
Fluid situation. Because apparently overnight the Russians had sent a barrage of missiles into Ukraine again. If that's their way of negotiating, I don't know when they will reach an accord. I'm going to say honestly, I don't know, Ryan. It's clear that there are two sides trying to make a deal. Like Trump is a deal maker, but it's going to be detrimental or costing an arm and a leg to other sides. So I'm not sure whether we are really close to a real deal, which is going to be. Well, I mean, a deal is never going to be good for any side, or one particular side will always be a bit left out. But this one seems to be a bit one-sided to me, to really fly, and so I'm not sure whether a deal is going to be possible. The issue what we're facing now is that if Trump doesn't get it the way he wants, that is to suck Ukraine dry of all its minerals, or at least he says half of them, but okay. Then there's a risk he completely pulls out, and then we are back to square one, and potentially back to square minus one, because that means a lot of support being pulled out as well. So that's somewhere where I see the risk right now, because it's kind of clear that the original plan is at least for what Ukraine and Europe is concerned, even perhaps NATO is going to be a no-go, right?
Yeah, exactly. And I mentioned in our chat with him yesterday that it's in Putin's favour to perhaps stall these things because he is making ground in Ukraine. So the more he takes now, the less he'll have to give up potentially later, which on the flip side might get the EU, US, Ukraine pushing for a quicker resolution from this. But yeah, it's going to be messy. I don't know if we're going to get a clean the war's over headline dropping. It's all going to be a long drawn out process. Lines are going to be drawn, argued over, and whatnot. We've already seen a bit of reaction in Risk on the fact that they are talking. So we could expect probably any further good news along those lines to feed into risk trades. But then probably at some point we'll forget about it as it drags on. But anyway, as you said, fluid situation. That's all I've got on the headline front because it was the US holiday, so pretty quiet. Anyway, one thing I want to mention though, we do have some data coming up today. We get US Empire State manufacturing numbers, and we got Canadian CPI. So if you trade in the loonie, keep an eye on those numbers there for feeding into expectations for the next Bank of Canada meeting. Now, what I would say is this data manufacturing, this Empire State numbers, it's first and foremost, it's been a bit flaky of late. So it's not been the bellwether it used to be. But all this data we're going to get this week, and we get Empire, we get Philly, and we get the PMIs, flash PMIs on Friday. This will be the first data a month after Trump. Okay, so this is potentially the first time we'll see any reactionary moves from businesses, sentiment from businesses over Trump's policies so far. Still pretty early days, only a month after, and it took a while before we started getting all the tariff headlines and whatnot. But sentiment moves pretty quickly. So this is the first data, as I say, we're getting since Trump took the hot seat. So it might show some indications of whether firms are pleased or not pleased with Trump so far. Right, that's it. Apart from the RBNZ later on overnight in the morning, whether they're going to go 50 or whatever they're going to do. Is it going to be a 50 and pause, or they're going to do 25 and keep a pause 25 on the table? Who knows? But that's the next big central bank event to come. Anything headlines you've got, Kay? Anything you want to add?
Nothing extremely market moving right now, Ryan. Nope.
Cool. Right, let's move on and see what's going on, which is not a lot. Dollar yen is having a little mooch around at the moment. We're back above, or have been back above 152, but we're just sort of swinging around at the moment. We had this move under this old fib 151.50, which was a bit of a level, as you could see on Monday. We had a little break, couldn't get all the way down towards these lows, low 151s, bounce back above 152, didn't last. So at the moment, this is looking a bit dead cattish off of this. One reason for that is that we've had US bond markets opening or reopening. Tens have crept back above the 4.5% mark after closing quite significantly below on Friday. But this is almost mirroring what we're seeing in dollar yen. This might be a bit dead cattish. So keep an eye on this 4.5% mark. If we're back below there, dollar yen's probably going to be following it again, and maybe we get a stiffer move if we're getting back down to these levels as well. So I think if we get a move down, back down to these lows down here, I think you've got to be very careful if that starts breaking. It could lead to a little bit of a washout moment perhaps, and then maybe we're looking at 150 pretty quickly. You got any thoughts on this one, Pete?
Yeah, it still looks like we are going to find rally sellers. Well, I mean, in yen, it's always difficult to define what a rally could mean. It could be 100 points or it could be 300, but it looks like we're finding rally sellers in all yen things. Although we are not holding below or starting to break massive levels or new big levels, it does look like we're finding a bit of yen buyers. The yen interest rates are also keeping their bid tone. Also, there is what I did pick up though is that line, and it's been going on for the past few days about this Japanese Alaska LNG project. You know, Japan still needs to import a lot of energy, and it's a big project, and it's been delayed for quite a while. But it does seem now that the door is open for this project to finally get on the road again, and all of those little things that are happening seem to be a bit yen positive. Whether it be the data that we saw in Japan, whether it be those projects, because if you manage to get into such a project to import parts of your energy, if you're part of the project, the you only pay production costs, so to speak. You don't pay too much of taxes or so to get it. It all still looks a bit positive for the yen right now. So that is one of the reasons I think why we see this continued positive vibes in the yen. Obviously, the US yields are important to it, but what's happening on the other side of the coin looks still relatively positive for Japan to me right now, Ryan.
Yeah, pretty much agree with that. And this trend is continuing. It's been down since the start of the year, final part of last year, and it's continuing. So there's no reason to change it just yet. But that's why I think if we do get a move down towards these lows, you've got to be wary of the potential breakdown and keeping the trend going. Dollar CAD, that had a little mooch back above 142, didn't last long. Then we're back below this area here as well, this line down here around the 90s. Still another one looking a bit dead cattish as well, not even looking like he wants to go up and test the break point at 142. 60, 70. So I'll be keeping an eye on that. If we get a move up there, depending on the driver, I may add back to my shorts that I took on the break here. But for the downside, we need to get through 41.40. Do that, we're probably going to be down at 41 not long after. And that's a level there, 41.0506 down to 40.90-ish, 85.90-ish. So that'll be the support zone if we get down there. I've owned a little bit of a dabble in cable. I decided to take a couple of shorts in the quid late yesterday evening. I sold a bit of cable up the top, been slicing that under 126. This is the key level for me, 126, 126.10. Okay, unless we're holding above that area, there's a chance of a pullback how shallow that pullback is or deep it is remains to be seen. At the first instance, 125, 45, 50 would be the ideal point of testing. But unless we start to really build above here, it might be a bit of a struggle to keep going. We'll have to see what happens with that one. Okay, you're on the other side of this one still, aren't you?
Yeah, but I've been in it for quite a while now, Ryan. I've been trading it around. I was fortunate enough to be able to offload some in the 126s as well. I've been basically long since what is it, 3.5 or so. Yeah, I'm just keeping it because of I'm looking perhaps at it from a slightly different angle. There's a bit of a wedge there, which I'm looking at when you put it's just a short-term one, that little line from the high on the 24th over the high of the 24th of January, Ryan, and then no, just yep, that one there over there. No. Take the lower high, the high on the 5th, 6th of February. You see the one that I mean? Just the next one. Yeah, over there. Yeah, that one. And then that is the way I'm looking at it right now. I mean, there's not one way to look at the charts ever, but there's a way I'm looking at it, and I'm just respecting that one because the market has. And if it goes away, I'll give back just smalls, and that's it basically. I'm not going to get married to this one anymore. But I found the bounce also interesting, although today it's a bit anemic. But as you say, I like this look of the 126.10-ish. Above or below, perhaps to close the day will be important enough to do the next little leg.
Yeah, absolutely. And we've had these points all the way up. 124.50. We were up, turning around, and then we get the support. That's what you want to see. If you want to see a price kicking on, you've got to see when you hit these levels, it getting above and holding above. And we're just not doing that now. Doesn't mean we can't, but we're not doing it at the moment. Euro sterling was the other one. I decided to have a little buy-in round about where we are now. It's not looking the greatest, but we have got this bigger zone down here, 82, 50s, 70s, or 60s, 70s. So I might have a little add into there. Just a bit of range playing, really. I did think that the UK data might be a bit worse than what it turned out, which proved to be wrong. But I'm not going to worry. We've still got a pretty tight range here. Rallies need to get above this area here, 15, 20-ish. Then the old 83, 40 area. If we do find support into here, then maybe we see a bit of range playing going on. But under this zone, then we're heading back towards these big lows, which is really getting into some big long-term levels down here, which I'd like to have a little dabble long on that. But in the wider trend, this is looking a bit dead cattish in those terms as well. So wouldn't rule out a move down here, but it depends on what's happening in the UK versus Europe, of course. Mike, already got over Aussie dollar. So I'll let Kay take the Kiwi if you've got anything in that. What else? Just stocks, and I was saying this yesterday, and it's still valid today. Just looking at the S&P, we've got futures or whatever markets your platforms are plugged into. Just break into new highs, okay? But just be wary. This is the cash market, okay? This hasn't made new highs. Obviously, it was shut yesterday. So watch the open for this one. If we're opening above here, 27, 28, then we're probably off to the races. Even if we don't open here, but we find, we dip to 61 and bounce, that would then suggest we're probably going to go on and break those highs anyway. But if we don't open up here, or we open up below here, or we go below here pretty quickly, then watch out. We may get a bit of a washout, maybe down, I don't know, 60 and a half, something like that, 60. But if we do open up here, then we're probably off to the races, and then we'll be seeing where the highs are going to come in next. But just keep an eye on that, as I say, when markets open. Right, Kate, let me pass it over to you, mate.
Yeah, it's kind of, if you stick on there, it's kind of funny
Yeah.
that equity markets just continue to plow on, despite uncertainty that we have on the geopolitics. So this does not seem to be the one that equity players are extremely focused on right now. Maybe they'll have to, but it is it is a bit I think, well, strange is not the right word, but typical that money still needs to work to get to work until you see clarity in a situation. And I reckon it's more that case than really thinking that everything is going to turn out to be rosy. There's a lot of people talking about the underperformance of Max 7s and stuff, but then when you look at the global equity markets, there is absolutely no cloud in the sky, right? Apart from the usual setbacks when geopolitics are uncertain, when you get like one data point which is not great. But until proven wrong, this equity market is probably just going to continue to plow on.
Yeah, I mean, in one sense, I mean, it could just be pure old school positioning. Pretty much global rates are coming down, or fast in some places, slow in others, which should, even though we're talking about, or a lot of central banks are talking about just removing restrictiveness, it should become potentially stimulative, which is back in the old days when we both had hair, used to be, bullish for stocks. Could we be
Yeah.
seeing that and we've just forgotten that's how it used to work?
Well, I mean, it's totally possible, Ryan. It's just that the bond market is not really showing the the impetus that an equity market should need. But we've been saying, like, with the situation being so fluid, with it is just, I reckon, the case that that yeah, I mean, money managers, they make the difference between, am I getting more value out of being in stocks, or just going into bonds. And you know that asset managers and stuff, they work with percentages between one and the other markets. And I guess they still their models are still saying, like, no, stick to equities because they are giving you the better returns if you look at the EPS and stuff included. So if you look at global returns, they're probably still better there because the bond market is still so hesitant.
Yeah, yeah, very much so.
Right.
Um,
Let me
yes, all
grab
right.
Kiwi.
Yeah. Brad, you're saying you remember me with hair. Well, I don't think you knew me that long ago. I can tell you that. Right, all yours, mate.
Cheers. So the Kiwi. First of all, who was asking about the Kiwi? Yeah, Mike. So first of all, Mike, look at the global picture. It's still very much it's still weak. I think we really have to go and break those levels here that we've seen in the past to really get going. In the meantime, we've got a bit of a positive half positive play going on, but we've got RBNZ tomorrow, right? If they go 50, and we never know what ore is coming up. That's the thing. He is a bit of a weather vane. He can go from bullish to hawkish to dovish to back to hawkish over the a set of 2 or 3 meetings. So we never know what he's going to come up with. But what we have seen is that we've been building some kind of a wedge here. The top side comes in around 57.60, and that, if we would get up there, that brings us right into that traffic zone that we saw here before. For Kiwi really to take off, I think we need to break that pattern here and really kick on for 58, 58 and a half. That may be changing the whole thing in the longer term. Okay. Until then, this could still be just a consolidation and bearish wedge or flag or whatever, and we could go back down. So keep a close eye on what the RBNZ is going to do overnight. If you look at the levels until then, I think the 57, 30, 50 is going to be a bit of a zone there. This could end up being your pivot again. Around 57, the figure in the Kiwi could be your pivot zone around which we turn post RBNZ. Because if they really cut 50, we can go and have a look at 56 and a half, 56.60, and then depending on the speed, we come back up to 57 and maybe break back higher. That could mean that this is still ongoing, and then we are going to see a bit higher levels potentially. Okay, but for the time being, I think the jury is out. We have seen the top. I think it's pretty useful, this one, because you've got a relatively defined area 56.60 on the downside, and then you got that 57.30, 50 top side. Yes, you can stretch up to 57 and a half, 57.70 post RBNZ, and then you will see what happens there. But these are kind of the levels that we are trading it in right now. What what I where I'm in doubt about the Kiwi, but we've seen, like as Ryan already pointed out, this Aussie Kiwi, we came down before the RBA, and we shot up after the RBA. Can we see something to the other side for the RBNZ? Totally, okay. And I think that will be this Aussie Kiwi is going to be a driver, I reckon, for everything that's going to happen in the Kiwi as well post RBNZ, because we have seen that the Aussie has held up relatively well around that 63.30 that Ryan was showing, and it we could see some kind of similar situation develop in the Kiwi. So if they cut, get down, and then bounce again. The the thing is, if they do only 25, then it's a bit of a more difficult case, in my opinion. Because if they do 25, we can go up and then needing to revise what's going on. So that's how it looks in the Kiwi for me, at least. I'm going to quickly run over what's happening in the metals, and because I don't have too much to say really. Gold held a little bit of there's a bit of a new trend line forming, and that is coming in around 28.90. So this 28.90, 85.90 is going to be again an interesting zone to me. We're turning around the top line of that prior channel. So I'm going to say, globally speaking, it's extremely bid still, extremely bid still. Okay, but in the short end, we've tried it again to get up to that the 29 30 40 on Friday, and then we came back up off quite sharply. It's going to take something to take it up to that famous 3000. Perhaps something fresh, okay? And I would say, if there is very negative news on negotiations, perhaps around in Ukraine, that could be a catalyst to take it up. Now, I think it could hang around here a little bit until we see clarity on those negotiations, or at least some form of responses to the negotiations. Silver saw the same pretty sharp setback on Friday. Both metals did it, and actually very good call by Stelios, who said exactly that in our room, that on Fridays we could see setbacks in the metals. That's exactly what happened. But we are inside this channel now. We had a bit of a spike above and then came back inside. A bit of an intermediate support starting to show up, which is low 32s. And the top side is still 32 and a half. We're turning around here. This to me is a bit of the when the saloon door quiets down and comes back to a standstill. This is now the 32 and a half for me. It can go up, back up to 33 and a quarter, back down to 31.60s around here, and still playing around inside this channel going up. Again, I'm going to repeat what I'm saying all the time. Silver to outperform gold needs a bit better news than than gold, really. Okay, so if there is any decent news, I think silver could actually push on. All right, so that is it. And then lastly, just because you liked it, Brand, this euro dollar chart. This is, I think, the short term 104.5. It's been a playground before, been a bit of a battleground playground. This 104.5 is your short term level to watch. If we start to get below, I think we can get back perhaps closer to 104, the figure, with an intermediate station around 104.20. If we hold here, though, this this kind of pattern here can continue to develop, and we may see a move back into the 105s. I am still, in the global scheme of things, I'm still a bit reluctant to start really buying euros, because I'm a bit afraid that this whole geopolitical situation, however we are going to turn it, is going to cost an arm and a leg to the eurozone. Um, we also have those German elections upcoming over the weekend. We will talk about that again on Friday probably, but this could be a bit of a mover, right? We've already touched upon it with Ryan, because we are seeing this global shift to the right in European countries as well. Will this impact the euro in a certain way? That we may get an answer to that come Monday. Okay, we may really get an answer to whatever happens in the euro come Monday after the German elections. And Ryan, I'm giving this back to you, mate. That's
You got anything on
oh,
Quid Swiss?
Sterling Swiss.
Yeah, just David was asking on
Oh,
that one.
sorry, Sterling Swiss. Sterling Swiss. Yeah, well, David, you see this big triangle that we have been forming over the course of really since the pandemic. We're turning around the top end of this triangle, 113, 113 and a half. We're actually right on it. Okay. Um, Making predictions on this one is a bit funky, but we see that we came out of this bit of a channel. Okay, so I think 113 should show up as a support, max 112, 80, 85. Top side, we need to break back above 114 to push on. If you break back above 114, we probably are going to be looking at slightly higher levels. Keep an eye on both sides. Swiss is a low yielder. It's a real low yielder. Okay, so if anything, I would possibly think that we find bids if we get back down to 113, the figure-ish, or yeah, 113 the figure, 112, 85, 95. That could be a zone if we get back down there, where we find some support right now from the technical side of things, David.
Thank
Yep.
you very much, mate. Yeah, cheers. Good stuff as always. Hope that's got you all sorted, David. Good stuff. Right, well, thank you as always coming to the Flow Show, supporting us here. I'm going to be off from tomorrow, the rest of the week for kids' half term, bit of running around. So I'll leave you in capable hands. We will see you all on Face later for those who are around for that time. Have a good day, everybody.
A good few days off, Ryan. Thanks, everybody.